Okay, I now want to talk about cost of goods manufactured, cost of goods sold. In order to talk about cost of goods manufactured, like what was the cost of the products that we made this period, and then what is the cost of the goods that we sold this period? I want to start from the very beginning of the process. And again, we have an account that we were referring to as raw material. And then raw material is the first account. Things go to an account called work in progress. I hope it's okay that I abbreviate. And then it goes to finished goods. I was saying each one of these accounts is a balance sheet account, and so we can think of them as T accounts. Raw material is a T account. And there are two concepts in raw material that I want to highlight. At the beginning of the period, we could still be making tables. I could have a bunch of wood on hand, beginning balance, and I'll just make stuff up. I have $1,000 of my beginning balance in raw materials. Then I can purchase raw material. I can go out and I can acquire more raw material. And if I were to acquire more raw material, I would purchase, and I could purchase, say, 5,000. The beginning balance plus everything that I purchased during the year is going to be raw material available to be used. And in my example, I have 6,000. Now, what we do at the end of the period is we go to the raw material inventory account and we quantify how much our ending inventory is. And in this particular example, let's just say that our ending balance, excuse me, was 2,000. If I had 6,000 available to me and 2,000 at the end, then I must have used 4,000. Okay, I can then talk about work in process. Work in process, just like raw material, that could also have a beginning balance, right? I could have tables that were unfinished on December 31st, and therefore on January 1st, I could have a beginning balance. So I'm going to make stuff up. I just assume that I have 5,000 worth of unfinished products that I'm making. Then during the year, I'm going to incur 3 specific costs, and we said those specific costs were direct material, direct labor, and manufacturing overhead. Okay? Direct material, I could just at least now assume that it's all the raw material that I used. I have direct material purchased and direct material used. The input into work in process is the direct material that I used. Okay? So I could use 4,000. Then I incurred direct labor. Again, I'm going to make that up. I could say that I incurred 6,000. And then I have all of these manufacturing overhead costs. I have indirect labor, indirect material, depreciation on the factory, rent on the factory, utilities on the factory, etc., etc. I will just make this up again. 2,000. The cost that I incurred is going to be direct material, direct labor, manufacturing overhead. So costs incurred. And that will be 12,000. I could refer to costs incurred as manufacturing costs this period. Okay, so beginning balance plus all of the costs that I incurred this period will be all the costs to account for, right? And in my example, that would be 5,000 plus 12,000, so it would be 17,000. And just like the raw material account, I would go to my work in process inventory and I would quantify the ending balance. I would physically count everything, right? Because what could happen is there could be costs that uh, employees could have stole some material, or we could have damaged some material. We don't want to back into ending balance, right? We want to quantify ending balance. So my ending balance, let's say that I go quantify my ending balance and I come to the conclusion that my ending balance is $3,000. Then it must be the case that the cost of goods manufactured is 14,000. The difference between all the costs that I'm going to account for in work in process minus my ending balance. Okay, so then now the last account to reconcile, finished goods. And just like the other two balance sheet accounts, I could start the period with a bunch of completed tables. Maybe I have $20,000 worth of tables that have not yet been sold. I would then add cost of goods manufactured, right? What I just transferred from work in process to finished goods. And in this example, it is 14,000. Then just like all the other accounts, I have goods available for sale. And in my example, that would be 34,000. Then I would go look for and quantify the ending balance. Let's just say that I quantified the ending balance and I have $12,000 worth of tables. It must be the case that my cost of goods sold is 22,000. Okay. That is the flow of costs in the T accounts. Now, there is also, like, obviously, there are schedules that go, maybe not obviously, but there are schedules that go with these. And my sense is that maybe it's easier for us to deal with the schedules if we were to just start working on homework. In fact, I could show you maybe the schedules. Um, let's find a good. Mm, let's see if we can find good schedules. This is a great schedule. But rarely are the PowerPoint slides very good, but this is an excellent PowerPoint slide. And it is slide 27, right? So the first section is, bear with me, it's the raw materials account. And I think I can draw on this. But this first section, let's include a little bit more. This first section is raw material, right? And again, we had beginning balance, and then we have all of our purchases. That would be this, what we were just talking about. Then we would have raw material available for sale. And then we would back into, or not back into, sorry, we would quantify ending. And that would yield materials used, which is that. And that is an input into our work in process. Okay. The second input into work in process is direct labor, right? And there's no account for direct labor. We just quantify that. Then we have a bunch of indirect costs, which is what number 3 is. And again, we have indirect labor. There's no indirect material in this particular example, but we do have factory utilities, repairs on the factory equipment, property taxes on the factory. Anytime that we're dealing with factory overhead, we always want to look for factory, right? So we could have property taxes on the sales facility. We can have repairs and maintenance on like the fax machine in the sales office. That would not be factory overhead because that's not part of making the product. Those would be period costs way down the bottom of the income statement. Okay. But here is my total manufacturing overhead, total factory overhead. These three costs are the three costs that we incurred this period. And then it looks like we are going to add beginning work in process, right? Work in process also has a beginning balance, and then it has the direct materials used, direct labor, manufacturing overhead for everything available. Then we would subtract out ending, which is probably this right here. And that would back into cost of goods manufactured, right? It's cost of goods manufactured. This is a great schedule. Great schedule. Best schedule we have. Then these two schedules, these are not bad schedules, but it's the same concept. We have the income statement. So we would try to quantify cost of goods sold. And cost of goods sold, again, is the finished goods T account. And we would have beginning balance, right, which is this. And then we would have finished goods that were transferred, cost of goods manufactured. That was what we just quantified in this example. That came from our cost of goods manufactured schedule, right? The more detailed one, 170,500. They're just abbreviating it here in slide 29. And then we would subtract, right? This would be everything available. Then we would subtract ending balance to get cost of goods sold. And we're doing that right here. And this is our cost of goods sold. And then we have all of our selling expenses, all of our G&A. Those are operating expenses. We incur those in the period that we recognize those as expenses in the period that we incur them.